All right, let's break down Planet's third quarter earnings from December 10th. And look, this wasn't just a good report, it was an absolute blockbuster. It literally sent the stock into orbit. So let's dig in and figure out why. I mean, just look at this. The market's reaction was immediate and frankly explosive. The stock just rocketed up over 35% on massive volume the very next day. So the big question is, what on earth was in that report?
Okay, here's how we're going to tackle this. First, we'll hit the headline numbers, the stuff that really lit the fuse. Then we're going to uncover the core engine that's driving all this growth. After that, we'll look at their game plan for the future. And finally, we'll wrap it all up with our take, what we're calling the next call on the stock.
All right, first up, the top-line results. This is really what got the whole rally started. And frankly, the numbers, they were just undeniable.
So Planet didn't just squeak by expectations, they completely blew them out of the water. We're talking revenue over $81 million, which was a full $9 million more than Wall Street was looking for. That's an accelerating 33% growth year over year. And on earnings, they hit break even on a non-GAAP basis, which just crushed the consensus estimate of a 4-cent loss. A huge beat.
But here's where the story gets really interesting. If you look at the official GAAP number for earnings per share, it was actually a pretty big miss. So what happened? Well, the market completely chose to ignore it. Instead, all eyes were on that non-GAAP number, which, it gives you a much cleaner picture of the company's real operational momentum by stripping out all those non-cash accounting items. But honestly, this right here, this is the slide that gave investors real confidence. It's all about the forward-looking metrics. Their backlog just exploded, up 216% to $734 million. And even more impressive, their RPO, that's remaining performance obligations, basically firm contracted revenue for the future, that grew an absolutely astronomical 361%. I mean, that's just incredible visibility into future growth.
Okay, so where did all this explosive growth actually come from? Let's peel back the onion a bit and look at the real drivers powering the business.
During the earnings call, CEO Will Marshall was crystal clear about this. He said the story is all about momentum in their AI-enabled monitoring solutions. And the demand for that stuff is absolutely surging from one sector in particular: defense and intelligence.
And this slide just perfectly illustrates that success. I mean, they just rattled off a whole string of major wins. A prime contract with the NGA for AI-driven maritime awareness, a 7-figure expansion with NATO, plus huge renewals with the U.S. Navy and the National Reconnaissance Office. This isn't just talk, it's tangible proof that their strategy is really paying off.
And to pour even more fuel on that fire, they also dropped the news that they're acquiring Bedrock Research. Now, this is a classic strategic move, right? They're basically bringing a super specialized, high-demand AI team in-house. Why? To scale their capabilities and meet this massive wave of government demand even faster. It's a smart play.
And here it is, the result of all that in one simple chart. You can see it clear as day. The defense and intelligence sector was the undisputed growth engine, expanding over 70% year over year. It completely dwarfed their other segments and was really the sole driver of the entire beat.
But this story wasn't just about the amazing quarter they just had. Management also used this moment of strength to lay out a really bold, ambitious vision for the future, a vision funded by their current success.
So they've got two huge initiatives now on the official roadmap. First up is OWL, which is their next-generation satellite monitoring fleet. Pretty cool. But the second one, this is the one that really gets you thinking, Project SunCatcher. It's a funded R&D project with, get this, Google, and the goal is to literally put data centers directly into space. Wow.
And because Q3 was so strong, management felt confident enough to raise their guidance for the entire fiscal year. And not just on one metric, but across the board: revenue, gross margin, and, really importantly, adjusted EBITDA. They're now signaling they expect to be profitable for the whole year on that basis, which is a huge milestone.
Okay, but with all this good news, all this ambitious investment, there is a catch, a very specific, near-term trade-off that investors really needed to wrap their heads around.
So check out the guidance for Q4, the quarter we're in right now. It actually points to a sequential dip in revenue, a pretty significant drop in gross margin down to about 51%, and a return to an adjusted EBITDA loss. Now, on the surface, that looks like a big step backward, right?
But the numbers here really tell the full story. Management is being super transparent about this. They're essentially using the whole year's profitability to fund an aggressive investment cycle in Q4. This is being driven by things like partner fees for their AI solutions and costs for new satellite contracts. It's a strategic choice,
sacrificing a little short-term profit for a lot of long-term growth.
So how do we pull all of this together? You've got the massive beat, the huge backlog, and this intentional Q4 investment. How does that translate into a forward-looking thesis for the stock?
Well, looking ahead to the next earnings call, there are three crucial things we're going to be watching. Number one, can they actually deliver on that tricky Q4 guidance? Number two, can they keep up this incredible momentum with defense contract wins? And number three, can they show us some real, tangible progress on those big, futuristic innovation bets like OWL and SunCatcher?
All right, so our official call is outperform. I mean, the market's powerful 35% pop tells you everything you need to know. Investors are clearly willing to look right past that short-term Q4 investment dip. Instead, they're pricing in the massive, highly visible backlog and Planet's incredible long-term strategic position as a key partner in the defense and AI space.
We really believe the company has hit a true inflection point. The stock has re-rated higher, and now it's all about execution. They have a crystal clear path to convert that enormous backlog into sustained, profitable growth, right after this investment cycle is over. The bar has been raised, no doubt. Now they just have to clear it.
And as always, this is not financial advice.